Right now, as we look at the board on this Monday morning, Beyond Meat is trading at exactly 96 cents per share, down 1.72% on the session. Seeing a former market darling that once commanded triple digits now fighting for its life in the sub-$1 penny stock territory is a sobering visual. But the ticker moving to 96 cents is not just another red day. It is a critical psychological and structural breach. We are officially in the danger zone, where the mechanics of the market shift from institutional investment to algorithmic predation. And if you are holding this stock or watching it, you need to understand that the rules of engagement have completely changed as of this morning. The expectation from the retail community has largely been one of dormant optimism, a belief that the brand is too recognizable to fail, and that a return to $5 or $10 is inevitable once the cycle turns. The reality, however, is far more aggressive and dangerous. What we are witnessing is not a standard market correction, but the potential beginning of a liquidity trap known as the death spiral, triggered by the company's recent massive dilution events and the looming threat of NASDAQ non-compliance. While the average investor sees a cheap stock, the smart money sees a company that has fundamentally altered its capital structure to survive, flooding the market with hundreds of millions of new shares that are currently suffocating any attempt at a rally. This morning's price action confirms that the market is struggling to absorb this paper, and the tension between the hope for a turnaround and the reality of this dilution is where your opportunity and your risk currently sit. Let's dig into the immediate price action we are seeing right now on the intraday chart. That drop to 96 cents is significant because it likely triggers a cascade of stop-loss orders that were sitting right at the $1 mark. When a stock that is widely held by retail investors breaks the buck, it often flushes out the last of the hopeful holders who had $1 set as their mental line in the sand. You can see on the chart that the volume has remained relatively consistent, which is actually a bearish signal. You would want to see a massive spike in volume indicating capitulation and a washout of sellers, which often marks a bottom. Instead, we are seeing a slow, grinding descent, which implies a lack of buyers rather than a panic of sellers. This slow bleed is often more dangerous than a crash because it suggests that the institutional bid has completely evaporated. The market makers are walking the price down to find where liquidity actually exists, and so far, they haven't found a solid floor. This brings us to the most critical aspect of the current situation that you need to be aware of: the short-selling dynamics. Beyond Meat has become a battleground for short sellers, but not in the way you might think. We are looking at a short float that has hovered around 37%, which is an astronomical number for a company of this size. But here is the nuance that most people miss. The days to cover ratio is currently sitting at over 14 days. This is the metric that matters. It means that if all the short sellers wanted to close their positions at the same time, it would take them 2 full weeks of buying every single share traded at average volume to get out. This creates a highly volatile powder keg scenario. The shorts are currently comfortable because the price is drifting down, but that 14-day coverage ratio is a trap door. If any positive catalyst drops, a partnership, a buyout rumor, or even just a macro rotation into risky assets, the liquidity simply isn't there for them to exit gracefully. They would be forced to bid the price up vertically to find shares. However, you must look at the borrow rates. The cost to borrow BYND shares has been spiking, sitting well above 25% recently. When borrow rates get this high, it usually indicates that the easy shorts have already been taken and new shorts are paying a premium to enter the trade. This often happens near a bottom, but it can persist for weeks if the market is convinced bankruptcy is on the table. You need to watch the Regulation SHO threshold list closely this week. If Beyond Meat appears on this list, it means there are significant fail-to-deliver positions, where short sellers have sold stock they haven't actually located. This can sometimes lead to forced buy-ins by brokerages, which creates artificial buying pressure. If you are trading this, do not just look at the price, look at the borrow fee and the fail-to-deliver data. Those are your leading indicators for a potential squeeze. We need to address the elephant in the room regarding the business itself, because a stock doesn't drop to 96 cents without fundamental cracks in the foundation. The recent third-quarter financial results for 2025 painted a picture of a company in active contraction. Revenue came in at just over $70 million, which is a double-digit decline from the previous year. But the real story isn't the revenue drop, it is the margin compression. With gross margin sitting near 10%, the company is barely making a profit on the actual production of its burgers and sausages before it even pays for marketing, legal fees, or administrative staff. This is a disastrous profile for a manufacturing business. The cash burn has been the primary killer here, forcing them into the debt restructuring that we saw in October. By exchanging convertible notes for equity, they essentially printed over 300 million new shares. This is why the stock is at 96 cents. It is simple supply and demand. The supply of shares exploded, and the demand for the product stagnated. Investors are also digesting the news of the company ceasing substantial operations in China. For years, the China growth story was a key pillar for the bull case for Beyond Meat. The idea was that tapping into the massive Asian market would solve their demand issues. The reality has been a harsh lesson in supply chain complexity and local competition. By pulling back, they are cutting losses, which is financially responsible, but it also kills the growth narrative. Without a growth story, a company trading at these multiples, even at 96 cents, looks expensive when you consider the debt load. The market is now pricing BYND not as a growth tech stock, but as a distressed packaged food asset, and those valuations are typically very unforgiving. There is also a significant regulatory clock that has started ticking the moment we broke $1. The Nasdaq Stock Exchange has a minimum bid price requirement of $1. If Beyond Meat closes below $1 for 30 consecutive business days, they will receive a deficiency notice. This is a formal warning that starts a 180-day period where they must regain compliance. Why does this matter to you right now? Because companies in this situation almost always resort to a reverse stock split to artificially boost the share price back up. For example, they might do a 1-for-10 split, where 10 of your shares become 1 share, and the price moves from 96 cents to $9.60. While this keeps them listed, history shows that stocks often sell off aggressively after a reverse split because it's viewed as a sign of weakness. Short sellers love to target companies post-reverse split. So, if you are holding for the long term, you need to be prepared for the possibility that your share count will get cut and the volatility will increase. Let's pause for a second and take a pulse of the room. I want you to comment below with your honest position. How many shares of Beyond Meat do you currently hold? And more importantly, what is your average cost basis? Are you averaging down at these levels, or are you waiting for the dust to settle? I'm seeing a lot of chatter on the forums about people loading up here for a potential buyout, and I want to know if that's the consensus among you as well. Moving back to the analysis, we have to talk about the institutional landscape. In 2024 and 2025, we saw a mass exodus of the large institutional funds that held BYND in their ESG, environmental, social, and governance portfolios. As interest rates remained higher for longer, the patience for unprofitable companies ran out. What we are left with now is a shareholder base that is heavily skewed towards retail investors and high-frequency trading algorithms. This makes the stock incredibly reactive to news. When institutions leave, the stabilizing floor of the stock price disappears. You don't have those large mutual funds stepping in to buy the dip at 95 cents because it fits their 5-year model. They're gone. This means the price action is now driven by sentiment, technicals, and short-term flows, making it much more dangerous, but also much more explosive if a squeeze triggers. The future outlook here hinges on 2 potential paths. Path 1 is the zombie scenario, where the company executes a reverse stock split, continues to burn cash, and eventually gets taken private at a distressed valuation or faces restructuring. This is what the bond market seems to be pricing in, given the yields on their debt. Path 2 is the strategic pivot. This would involve a major legacy food conglomerate stepping in, not necessarily to buy the whole company, but maybe to license the technology or buy the brand IP. At a market cap that is shriveled to this size, Beyond Meat becomes a bite-sized acquisition target for a giant like Nestle or Kraft Heinz, who might want the brand without the operational baggage. However, relying on a buyout is a speculative gamble, not an investment strategy. We also have to consider the consumer shift. The plant-based novelty has worn off, and we are now in the phase of the adoption curve where the product must stand on its own merits regarding taste, price, and health. The recent pushback against processed foods has hurt the entire sector. Beyond Meat has been trying to reformulate with cleaner labels, using avocado oil and reducing sodium. But these changes take time to filter through to consumer perception. The disconnect between the company's mission, which is noble, and the consumer's wallet, which is pinched by inflation, is the core friction point. Until they can reach